Bankruptcy is widespread in the current world situation, and its severity may go unnoticed until a cherished restaurant or store shuts down due to financial troubles. Nevertheless, it's essential to recognize that bankruptcy affects not only small businesses, but also large corporations. The path to recovery for these companies remains uncertain. However, it's crucial to stay informed about measures to protect yourself and your business during such turbulent times. Salutations, finance trailblazers. Nova Society is your secret weapon for success. In case you haven't joined our ranks, become a subscriber and let's conquer the financial world together. If we could get 300 likes on this video, that would be insane because we love making these videos just for you. Well, of the many warnings that we discussed in our other videos, here's some more concerning information that you need to know. According to the latest report from S&P Global, a significant gauge of economic performance is the rate of corporate bankruptcy filings. The pace of U.S. corporate bankruptcies continued persistently in September, concluding the quarter with the highest number of bankruptcies thus far in 2023. S&P Global Market Intelligence documented U.S. corporate bankruptcies picked up speed in September with 62 new filings. The elevated monthly bankruptcy figures in 2023 contrast with the notably sluggish pace of bankruptcies in 2022. Several financial experts and analysts anticipate an economic downturn in 2023, which could lead to a surge in bankruptcy filings. On the other hand, S&P Global Ratings foresee an increase in defaults among the least creditworthy corporate borrowers in 2023. This projection is attributed to increased pressure stemming from declining corporate earnings, rising unemployment rates, and a more restrictive monetary policy. The September tally exceeded the revised figure of 62 bankruptcies observed in September. This increase was attributed to growing expectations that the Federal Reserve would sustain its benchmark interest rate at an elevated level for a more extended duration than originally projected, intensifying economic challenges. On this chart, it's readily apparent that the figure of 516 bankruptcies as of September, represented by the dark blue color, already surpasses the numbers from the previous 2 years and even exceeds totals for any other year since 2011. Now, here's the even grimmer part. There are currently 700 U.S. banks that exceed the official guidelines concerning their permissible exposure to commercial real estate loans, or CRE loans. In simpler terms, 700 U.S. banks have surpassed the FDIC's recommended limits for the extent of exposure that small banks should have with these CRE loans. Presently, small banks in the United States are holding more than 70% of these CRE loans, collectively valued at around $2 trillion. Vacancy rates in office buildings have already reached historical highs.
This whole damn office is empty.
And given the rise in corporate bankruptcy filings, it's almost certain that these rates will continue to climb in the coming year, particularly in 2025. The consequences for these small banks are exceptionally uncertain at this point. A significant portion of these bankruptcies is concentrated in 3 main industries: consumer discretionary, industrials, and healthcare. Consumer discretionary items are usually the first to be cut when consumers face financial challenges, as they tend to prioritize essential needs over non-essential wants. This year, the top 3 U.S. states with the highest count of corporate bankruptcies are Texas, New York, and California. As you can observe, bankruptcy filings have recently reached levels that are comparable to the periods of the Great Recession in 2008 and even the challenges brought about by the 2020 pandemic. Traditionally, this indicator signals economic underperformance and has, in the past, often preceded significant stock market crashes. Whether a stock market crash is imminent or not is a distinct matter, but historically this pattern has emerged. Companies are increasingly defaulting on their debt obligations. August marked the highest count of corporate defaults since 2009, and the number of distressed companies is anticipated to continue rising if the Federal Reserve opts for another rate hike this year. Just envision the potential consequences this would have on corporate debt that is soon coming due. According to S&P predictions, the US 12-month corporate default rate is projected to climb to 4.5% by June 2024. As of July this year, the rate stood at 3.5%, signifying an almost 30% increase within just a year. The most pressing concern revolves around the impending wave of debt that US companies are about to face. Approximately $790 billion is set to mature in 2024, and a more substantial sum of $1.7 trillion will come due the following year in 2025. When the Federal Reserve provides updates and pledges accommodating lending, they seldom address these impending debt obligations. The year 2023 may be drawing to a close, but the financial landscape they're looking at mirrors the figures we just shared, and they're fully aware of what's on the horizon. It's important to note that we're not talking about small businesses going bankrupt. These are substantial corporations. To illustrate, consider Yellow Corporation, which filed for bankruptcy in August. This bankruptcy encompasses tens of thousands of employees, signifying significant job losses.
I'm getting fired.
The sheer magnitude of debt that needs to be addressed within the next 2 years necessitates refinancing. However, a substantial hitch arises. The prevailing interest rates make it challenging to secure such refinancing. While some companies may be successful in doing so, not all will succeed, and those who can't refinance will no longer maintain these vast office spaces. Consequently, this will result in soaring vacancy rates and substantial losses for property owners. While we're currently centering our attention on corporate debt, it's vital to recognize that corporations generate their profits from their customers. Therefore, when we observe credit card delinquency rates on the rise and an increase in auto loan delinquencies, it offers us a more comprehensive view of the broader credit market's health. These companies are grappling with substantial uncertainty and a plethora of challenges at this moment. Although it typically takes several months for rate hikes to produce discernible economic effects, we are already beginning to witness these impacts through the surging delinquency rates and an uptick in corporate bankruptcy filings.
I declare bankruptcy!
These topics warrant attention from the Federal Reserve, yet they will likely evade discussing them because it may not align with their best interest. Just a month ago, Treasury Secretary Yellen expressed her anticipation of a soft landing environment. During her interview with Reuters editors and reporters, she said, "What I'm seeing in the economy is cooling in the labor market that's healthily taking place. That does not involve mass layoffs. It's some of the heat coming out of the job market." However, it's important to note that a surge in bankruptcy filings isn't unique to the United States. Europe is grappling with analogous circumstances. The economic conditions are even more challenging than those in the United States. According to a report by S&P Global, it is expected that default rates will persist in their ascent as aggressive rate hikes take their toll on companies that must contend with escalating funding costs and imminent debt maturities. By June of 2024, default rates in the US are projected to reach 4.5%, up from 3.5% in July of this year, while in Europe, they are expected to rise to 3.75% by June 2024, from 3.1% as of July this year. Mohamed El-Erian, who serves as the chief economic advisor at Allianz SA and also contributes as a Bloomberg opinion columnist, has expressed profound concern regarding the anticipated high interest rates and the considerable depreciation in the corporate real estate sector, both of which are his primary areas of apprehension. Corporate bankruptcies should serve as a cautionary signal for all of us, as their ramifications will extend to various aspects. These repercussions include employment and corporate profits, which may lead companies to contemplate reducing dividends and wage growth, and certainly the domain of commercial real estate as we just explored. In this context, the commercial real estate sector is at risk of witnessing substantial devaluation as companies grapple with defaults and bankruptcy. Once this unfolds, vacancy rates will probably surge and property valuations will register a significant decline. As valuations plummet, investments linked to these assets are poised to experience a pronounced loss in value. Hence, it is prudent to remain vigilant, especially if you are employed by a company facing challenges or have investments in commercial real estate, perhaps through your retirement funds, such as an IRA. It is advisable to closely monitor any updates and information related to this situation. If an increasing number of corporations opt for bankruptcy in the forthcoming months, it could entail several adverse outcomes for the economy. These ramifications encompass job cuts, diminished investments, disruptions in credit markets, and a decline in consumer confidence. The extent of these repercussions will be contingent on the quantity and size of the companies seeking bankruptcy protection. In cases where only a few small firms file for bankruptcy, the economic influence might be limited. Nonetheless, if a substantial number of firms or some large corporations pursue bankruptcy, the economic consequences could be substantial. Apart from the economic implications, corporate bankruptcies also bring forth a series of social ramifications. For instance, when a company initiates bankruptcy proceedings, it can profoundly disrupt the lives of its employees and their families. Employees may face job losses, loss of health insurance, and a depletion of their retirement savings, resulting in heightened stress and anxiety. Furthermore, corporate bankruptcies can adversely affect the communities in which these companies are situated. When a company ceases its operations, it may trigger a decline in property values and an upsurge in criminal activities. Additionally, it can create obstacles for other local businesses to thrive. Discover personal finance and generational wealth mastery on our channel. Subscribe now for empowering videos to boost your wealth. Don't forget to give us a thumbs up. We do want your help in reaching more likes to help our channel grow. Do yourself a favor, please click on the next video for more financial wealth building strategies.